Welcome back, you legends. I'm Dr. Ken. Let's get right into this video. So the stock market today, everybody, is up 2.6% on the S&P, 3.4 on the Nasdaq, and 1.86 on the Dow. Let's take a look at the different sectors. Leading today were cyclicals, followed by real estate, communication services, and technology. Again, a full-on risk-on day, highlighted by the underperformance of consumer defensives, energy, healthcare, and financials. So this is a typical risk on where hedge funds, money managers put their positions in risky assets and take them out of defensive positions like the dollar, like gold, like consumer staples. Let's take a look at the stock market map. And again, look at this. Green Thursday, super red Friday, super green Monday. Again, it's like watching a traffic light. This market is absolutely nuts. Big cap tech, super green, Microsoft up nearly 4%, Google up nearly 4%, Amazon over 6%, Tesla 7%. Now, this is exactly why I warned last week on Friday, do not short into the hole. This is a bottoming process. We have a bullish divergence on the PPI with a higher low on momentum and a lower low on the price action, typical of a double bottom formation. In addition to that, we looked at 8 different signals, all of which were bullish, at least in the short term. Now let's take a look at the 2-hour chart, everybody, for the S&P 500, and notice this, a gap up and then a move sideways. This now looks like a bull flag, and it's sitting at a very critical level, everybody. This is an acceleration zone, what I call an acceleration zone. We have a lot of gaps at this level, and so I would not be surprised at all to see a gap up tomorrow and a continuation of this move to the upside. Now, I'm not predicting a gap up tomorrow. I'm just saying do not be surprised if it happens, because we're sitting at this acceleration zone. And as I've said many times in the past, I do not believe in coincidences. The market is sitting at this zone for a reason. And in the post-market, we're already seeing the market up nearly $3 additional on the S&P 500. So where do we go from here? Well, interesting, everybody. These blue lines up top and down below at $369 and $345 are the weekly expected moves based on the options market. And so we're pushing really close to the weekly expected move. In fact, in the post market, we've already hit $369. And so there's a reasonable chance that we will actually overshoot the weekly expected move and then see a lot of choppiness for the rest of the week, especially with more earnings reports coming out. We could still see some serious chop, something that looks like this, and that would not invalidate the bottom at all. It's just expected volatility. Especially everybody, when the VIX is still above 30. Now, I did point out in the last video that the VIX is forming a topping formation, right? A double top formation. Every single time we've seen the VIX put in a double top formation in the year, we've seen the market rally and volatility cool down. Let's add the S&P 500 on here so you guys can see what happened at every double top in the VIX. And it was pretty decisive, everybody. We had a double top here, the market rallied, another double top, the market rallied, and then we now have a double top right here, and the market is double bottoming and now rallying. Now, I need to point out that the VIX could remain elevated at these levels in the low 30s, high 20s throughout this month, because we do have a lot of earnings coming out. Big company earnings are coming out next week, not this week, but next week. This week, we do have 2 critical earnings reports from Netflix and Tesla, and that will set the tone for the rest of the month. Now, let's take a look at the Nasdaq, the triple Qs, now beginning to outperform the S&P 500. Again, a check mark for a relief rally, a risk-on move. We have a double bottom formation with a higher low on the PPO and a lower low on the price action, again forming a bullish divergence, typical of market bottoms. Let's take a look at the HYG, and again, we're seeing a beautiful bullish divergence forming. What am I talking about? Well, the smart money is up top, the dumb money is down below, and today the smart money made a new high on a closing basis and on an intraday basis, while the S&P 500 hasn't gotten there yet. And so this tells me more steam is left in this violent short squeeze. Now, these divergences, everybody, have been 100% accurate in predicting reversals in the market. Let me just point out a few that I've spotted this year. This was one bullish divergence. It led to this short squeeze. This was another bullish divergence. It led to this massive, massive green day. This was another bullish divergence, and it led to this massive, massive stock market rally in the summer. This was a bearish divergence, a negative divergence, and it marked the top exactly. And we rode this down, making 100% on this move down. We got in again. Here we made another 100% profit on the way down. And at these levels, we've switched completely to being long, and we've closed out all of our short positions. By the way, guys, I do post every single trade and investment that I make in real time in the trading community. It's less than 20 bucks a month if you go for the annual membership, and it's the best way to support me and support the work if that's something you want to do. And you get access to a lot of cool stuff, including my trading activity, as well as weekly watch lists, market research, investment ideas, and so many other cool stuff. I don't day trade often. I do mostly swing trades. So if you're a busy person, this will be perfect for you. Now let's take a look at the dollar. And again, everybody, last week's video, I did say that the dollar is forming a double top formation, very obvious double top formation with a significantly lower high on the PPO with consecutive rejections. Momentum is now squarely bearish for the dollar, and as the dollar cools down, the market likes to rally. Let's take a look at the 10-year yield. Very similar look here, everybody, a double top. We're getting super close to the upper edge of this Bollinger Band, and we have consecutive rejections at the PPO with the fast-moving average trading below the slow-moving average, again indicating negative momentum in yields, and when yields cool down, the market likes to rally. Let's take a look at the gold divided by S&P 500 risk-on, risk-off ratio. This is one of my many ratios that I like to look at to assess risk on and risk off, meaning is the market going to move up or move down? And the logic is pretty simple, everybody. When money flows out of safety assets like gold into the S&P 500, we begin to see a rally in the S&P 500. And so when this ratio slows down, begins to move down, when gold begins to underperform the S&P 500 on a relative basis, and we get a bearish crossover on the PPO, it indicates that money is going out of gold and into risk assets like the S&P 500. And just look at every single time we had this this bearish crossover, the stock market rallied, and now we're going to rally. Now let's take a look at another barometer that I look at. This is the XLY, consumer discretionary, divided by XLP, consumer staples. And on this particular chart, everybody, it does look like that we are forming a bear flag, and so there's potentially more downside to come, especially, everybody, in the last week of October. This is our trusty seasonality chart, and look at this. October tends to be extremely weak in the last part of the month, and so we do have a big company earnings coming out in the last week of October, including Apple, and so we're going to see market moving events in October, and likely that last flush down, that final crash that I've been talking about for weeks and weeks and weeks, that's likely going to come in the back half of October. Now, this is very important, everybody, because this bear flag will likely break to the downside in the last week of October. And I just wanted to point out what happens when these bear flags form. This is an example. We rally all the way up to the 9-day EMA and even close above it. The same thing happens here. This yellow line is the 9-day EMA, and it's very common to see this line taken in these bear flag consolidations / stock market short squeeze rallies. And so we could see that getting hit really soon as tomorrow, perhaps even on Wednesday as well. And at that point, everybody, we will have taken the weekly expected move, the upper weekly expected move, and we will have completed this bear flag. And at that point, I'd be way more cautious at opening long positions. At that point, I would want to wait to see what happens with the stock market for the choppiness to play out, and especially for the last week of October earnings to be out of the way before I can add more to my long positions for that beautiful anticipated November-December rally. We do have the FOMC coming out with an interest rate decision on November 2nd. The Fed meeting will take place November 2nd. And so it's very likely to see this mark a turning point in the market, a reversal point in the market, especially if we've seen selling ahead of it. That would be very bullish because that would mark a turning point to the upside, a reversal to the upside on the other side. Again, seasonally speaking, in midterm years, November, December tend to be very nice, strong, bullish months. Another indicator that I'm looking at is the CPC, the put to call ratio buy and sell signal. This is my own signal, everybody. I developed this signal and I refined it over weeks and weeks and weeks. And it's a variation of an existing buy and sell signal. But this variation, everybody, is faster and more accurate. And I just want to point out how to read this signal and what happened after each signal was triggered. This was the first signal that was triggered this year. It was in April, and it marked the beginning of this massive sell-off. The criteria for a sell signal is 1, we need to be trading below 95 on the 5-day moving average on the CPC. Then we need to cross over, and we need to have a crossover on the PPO at the same time. That triggers a sell signal. Systematically, this happened here as well. Beautiful sell signal. This happened here as well. Beautiful, beautiful sell signal. Buy signal. For the buy signal, everybody, I need to see the CPC 5-day moving average trading above 1.1. Then I need to see it cross down below 1.1 with a cross down on the PPO at the same time, and it marks relief rallies. The same thing happened here, cross down below 1.1, a crossover on the PPO, boom, beautiful rally. Same thing happened here, cross down below 1.1, a beautiful cross down on the PPO, and boom, beautiful relief rally. Year to date, everybody, this signal has been 100% accurate in marking market reversals. And if you went long when it triggered and then you closed out your position and went short when the sell signal triggered, you will have outperformed the market nearly by 400% just in the last 6 months. Again, everybody, you can get this signal and many other signals that I've worked on in the trading community. If you want to support me, please check out the link in the description to join. Now let's jump to the big guns. This is the $1 million chart. Up top is the breadth indicator, the gold standard breadth indicator for the S&P 500, the percent of stocks above their 200-day moving average. And look at this monstrous bullish divergence. The S&P 500 made consecutive lower lows as this indicator made consecutive higher lows. And then again, it made a new lower low while this indicator made a new higher low. The last time this happened, everybody, was in 2006, and the market rallied by 15% just in the next 45 trading days. Now let's jump into the fear and greed, everybody. We've gotten out of extreme fear. We're now tilting towards fear, neutral, and perhaps even greed over the next few weeks. Market momentum, double bottom, and we're now rallying. Stock price strength is now reversing at a very critical point, similar to the same point that we've seen back in May. Stock price breadth, again, I showed you this breadth indicator, and it's much faster, much more accurate than the McClellan Volume Summation Index because it's a lagging indicator. Put to call ratio, again, I talked about this head and shoulders top. We saw it back here, and we saw it back here, and then we saw it back in January as well. And it always marks stock market bottoms and reversals to the upside. Market volatility, double top, and now we're rallying. Same thing here, everybody. We had a double top, we rallied, double top, we rallied, double top, we rallied, double top, and we rallied. So again, another clear-cut bullish signal. Safe haven demand is now declining. Stocks are beginning to outperform bonds. Junk bond demand is now growing. The yield spread between investment grade and junk bonds is collapsing, indicating more risk taking in the market. Let's take a look at the economic events that we have coming up. Tomorrow, everybody, will have industrial production. We also have Neil Kashkari speaking. Wednesday, we'll have housing numbers. These are going to be absolutely horrific because of the significant increases in mortgage costs and mortgage interest rates. Thursday, everybody, will have some initial jobless claims. We'll also have more housing data and more Fed speakers. Friday, more Fed speakers. This week, however, is not going to be driven by economic data per se. It's going to be driven by this earnings. In the pre-market today, I shared my most highly anticipated earnings results, what I expect out of them, and what I expect the market to do in reaction to them. Again, all in the trading community. Check out the link in the description below, everybody. Tomorrow we'll have Netflix after the market close. Wednesday we'll have Tesla and two key chips stocks, Lam Research and ASML. I've been following chips for a long time, and we've taken one of our biggest ever bets on one very specific chips company. where we have found a significant market edge. Again, if you're interested in this kind of info and market research, check out our trading community. Now, Thursday, everybody will have Snap. We'll also have Nucor and Dow, both basic materials stocks, steel and chemicals. And Friday, we'll have American Express, the first out of all of the payment processing companies to report. And I actually expect American Express to report better than feared numbers. Very similar to the banks, which again, as I expected, reported significantly better results than feared. Now, that's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.